Effective long-term tax planning in retirement can save you hundreds of thousands of dollars in legally avoidable taxes. That sounds crazy that it can make that big of a difference. Let's look at an example coming up. Welcome back to the most brilliant 18,000 financial minds on YouTube. For those of you who don't know me, my name is Steven Spicer, and it's my goal to help you not get killed in taxes and to overcome the significant risks to which mainstream advice leaves you exposed. Now, in this video in particular, we're talking about how much of a difference a thoughtful Roth conversion strategy can make on your overarching financial plan. From a tax perspective, for most retirees who have saved diligently for their retirement, this can make a massive difference, usually more than anything else, any other one strategy, at least from a tax planning perspective. Now, you may be able to pay hundreds of thousands more throughout your retirement and still make it work. In fact, that's what most people end up doing. But why?
Why? Exactly? Why?
Why would you when this strategy has such clear benefits? I have an idea as to why many don't, and we can circle back around to that at the end of this though. For now, let's jump into a quick example just to see how much of an impact a thoughtfully designed Roth conversion strategy can have. Now, if you saw this video about how this client was able to have a greater than 10% safe withdrawal rate in retirement, then you'll be familiar with our clients here, Steve and Sally. As a refresher, they were dealing with about $2.75 million with a spending capacity of more than $20,000 per month. We played with it. I think it ended up being about $23,000, but it was roughly this setup. And this is what their cash flows from various sources looked like as we planned for their retirement. So you can see that this is why their portfolio was able to sustain more on the front end, because most people end up having other sources of income coming in later on in life. And hopefully we're strategically structuring something so that that can happen. And this is their current, as the tax law stands today, tax projections with larger and larger tax hits due to required minimum distributions, RMDs, later in life. All right, so let's explore some tax strategies in retirement. And we can put this in today's dollars so that it's a little bit better perspective for this instance. So these are all different tax strategies that we can compare. And let's start with strategy 2 here, and we'll put in what most financial planning software does. So they tend to default to, instead of the pro rata rule, which is where you pull from everything a little bit all at once, a little bit of everything all at once, instead you're gonna pull from your taxable accounts first, and then your tax deferred, and then your tax free, which in this instance is a little bit better, marginally better than the pro rata scenario. This is what most financial planning softwares are doing, most of them. So that's why I wanna compare to this. So we'll look at this for our second strategy. And then our first strategy, let's figure out what the absolute best is going to be. Now, we can compare these different withdrawal orders, which you can see that there's not a huge difference. There's no difference between these two because this particular client does not yet have any tax-free funds. So we're gonna, with the Roth contributions, we're gonna be setting up their initial tax-free account. Everyone is a little bit different, and that's why something like this is beneficial to make sure that you're doing this kind of analysis on your own for your own unique scenario. So we're gonna compare these different orders of withdrawals to different Roth conversion strategies to see what ultimately is gonna make the most sense. Now, real quick, let me offer a brief explanation as to what we mean here when we talk about Roth conversions to a certain tax bracket. We will absolutely do thorough deep dives on the subject. So depending on when you're watching this, those may already exist. So you may wanna go poke around our channel if you're interested. But in short, the idea behind Roth conversions is that you have all this money in your tax deductible accounts, old 401ks, traditional IRAs, and so on. These accounts have been great to help facilitate savings over the years, as they have never lost any due to taxation. But now that you're in retirement, for the very same reason, they are your worst accounts, as they are still 100% subject to taxation. You have to be careful about when and how much you pull out of these accounts over the years. And you don't just want to let it sit there, as you will be forced to take withdrawals when you hit that RMD age, which has been moving up in recent years, but is currently at age 73 or 75, depending on the year you were born. After you retire, especially before you turn on your Social Security, your ordinary income will likely be lower than it ever has been or ever will be again. In other words, you are in the lowest tax bracket you've been in for a long time or probably ever will be again. This is the optimal time to get as much of your hard-earned money out of those now 100% taxable accounts and into a tax-free Roth IRA. That is a Roth conversion. Now, we don't know what taxes are going to be in the future. Sure, in theory, they could drop, but given the state of things, if they're going to go any direction, they really should go the other way. Regardless, I personally, and I think most people would agree, would just love to get rid of the variable. So you have one less thing to worry about in retirement. Now, in the Roth conversion strategy, we're evaluating the impact of you pulling additional funds out of your traditional accounts until your income hits the upper threshold of each of the tax brackets as we consider moving those funds, incurring that income today as far as the IRS is concerned, even though in this instance you don't necessarily plan to spend it. You're just moving those funds into your Roth accounts. So back to the computer, we can look at the impact of filling up these various tax brackets and see a side-by-side comparison of just how much of a difference it can make on the total taxes you'll have to pay over the course of your life and the total net income you'd be able to generate from your accounts. For Steve and Sally here, filling up to the 32% tax bracket is the clear winner. Although these two were close enough that if they were more comfortable taking smaller bites out of their traditional accounts each year and only filling up to the 24% tax bracket, that's not going to make a huge difference for them from a retirement income planning perspective and might be more digestible, smaller tax hits in those early years. But for the sake of this example, let's just rip the Band-Aid off, so to speak, and explore the 32% option here. You can see just how much of a difference it makes here when we compare these two strategies, this Roth conversion strategy versus what traditional financial planning software will illustrate. The difference between the tax rate is 18% versus 11.7%. That's a 6.3% less average tax rate over your retirement. And total taxes, $800,000 less, $812,483 to be precise if taxes never change and their spending strategy and everything stays the same. But for an apples to apples comparison, there's an $800,000 difference between these two plans. And we're only talking about $1 million versus $1.8 million. So this almost cuts our projected tax bill by almost 50% over the course of our retirement. It's insane. That's a huge difference just from this one change. You can look at the amount of income that we're projected is the inverse. What we don't end up spending on taxes, we get to spend in retirement. And then the net legacy, if we don't end up spending all of this money, which it depends on your goals as far as what you want. But again, we're just looking at an apples to apples comparison here. The difference is $400,000 at the end of life. Obviously, if you're looking at this and this is your retirement plan and you don't really care about leaving a legacy behind to heirs or charity, whatever it might be, then with this information, you go in and change your plan, right? Maybe we can spend more on a monthly basis. Maybe we can buy that dream house we've always wanted and still be able to hit all of our other goals. So again, we just freed up a lot of money, created a lot of flexibility in retirement that now our planning situation is going to change. Steve and Sally's planning situation is going to change because we're optimizing this for them and now have significantly more that we can work with, that they can work with in retirement. We can come over here to get a visual understanding of how Steve and Sally's tax situation over the years would be impacted based on this strategy versus what we were looking at before. So we're front loading these expenses, the taxes that they're going to have to pay, so that they don't have to worry about taxes on the back end, or at least unpredictable taxes. Now you'll see this tax burden that they have ongoing here is from the fact that they have stable lifetime income. They have multiple sources of income that we've helped build out for them. So they will owe taxes from that, but they won't have this increasing variable that is however large your IRAs are and the required minimum distributions that you're being forced to pull out that are increasing each and every year. We can compare that directly to that traditional advice and see how much of a difference that makes just visually. So see here, you can see this increasing tax rate in retirement. So as you get older, you get further into retirement, you're getting this larger and larger hit from your accounts. You're losing more and more, and that's where, it's just the difference of eating that frog early or putting it off and ultimately risking it being significantly larger. We'll come back to that idea in just a second. So yeah, with this Roth conversion strategy, we get to front load those expenses, get them out of the way, remove that variable, instead of risking that increasing tax at an increasing rate during your later years of life. Now, taxes could be zero. It just depends on your unique situation. For example, we'll look at where their accounts are at this point, but all of their accounts here are tax-free. So they don't have to worry about taxes from their investment accounts at this point. And then from a tax planning perspective, you can also go granular and look at each individual year just to get an idea of how you might want to adjust what you're doing to best optimize your taxes. Of course, in this year, for example, it looks like the long-term capital gains are being pushed above their threshold here. This is in the future, so maybe we need to think about when to take those long-term capital gains, or are there ways to decrease the other sources of income to pull those long-term capital gains back down below into that 0% tax bracket. If you don't know how long-term capital gains are taxed, you can look at the last video that we put out. I'll link to it up here. All right, now check this out. You've seen the legacy potential comparison between these different strategies, but let's go beyond just the dollar amount that we looked at. It said that there would be a difference of roughly $400,000. Let's look at the asset location of these accounts that you'll be pulling from later in life and how each of these strategies will look so different. Okay, so let's come up here first and look back at our traditional tax planning software and what it might leave you with if you're not implementing a Roth conversion strategy. Or at the end of your life, you're going to have a mix of tax balanced accounts and tax deferred accounts. So your normal investment accounts that are just getting taxed based on the capital gains over the years. And then your tax deferred accounts, which are your IRAs and your old 401ks, the ones that are being hit each year by those required minimum distributions, causing your taxes to go up and up. But if we look at how that compares to this Roth conversion strategy, and I know you already saw that when we got on this page, but those go away really quickly because we get all of that money into this tax-free account. So it's not just about the tax numbers or the $400,000 difference it can make at the end of life with these static variables. We know that it's not going to look exactly like this, but there is a value that is difficult to quantify when you think about what this would feel like in retirement, knowing that your accounts are tax-free. You could pull out large lump sums of money to spend on that lake house that you've always wanted and not have to worry about taxes, about that tax impact that it's going to have on a given year, right? If it's coming from a traditional IRA, I would have to think about, well, maybe I would want to take out a mortgage so that I didn't have to pull out $600,000 out of my Roth IRA all in one year to buy that house, even though I could afford it, even though my plan could sustain it, because we run through the numbers and we can see that the plan could sustain it. But pulling out that extra $600,000 in a year might move me up into a tax bracket that I don't want to be moved up into, the 35% tax bracket or whatever it might be. Might cost me a significantly larger amount of money than I'm ready to pay. But with this tax-free account, I don't have to worry about that. We've already taken the tax hit on the front end, and now we don't have to worry about it anymore. So even if there were no savings with all of this, even if there was a negligible difference, maybe even if this was worse, I would probably still want this. The flexibility that comes with a tax-free account like this. But it's not just for me. I mean, it's so much more tax efficient for my beneficiaries as well, right? Versus the traditional IRA, which they're getting increasingly strict about, but your beneficiary has 10 years to take those funds out, and that's incurring taxes over the years. They still have to get the funds out of your tax-free accounts, but they've already been taxed. So your heirs aren't incurring that additional tax after they've inherited this IRA from you. So there's so much more flexibility here. This is a pretty attractive strategy for a lot of reasons. That doesn't necessarily mean it's going to make sense for everybody, but it does make sense for a lot of retirees. Also, there are some risks to keep in mind. It's not as easy as just filling up that tax bracket, right? There's more to it than that. There are more things you need to keep in mind. For instance, I provided a very specific example in this video where I talked about how it might make more sense to only fill up part of a certain tax bracket so as to not trigger a long-term capital gains tax torpedo. Watch that video if you're curious. Also, you should be aware that similar to the age when you take your Social Security benefit, as I break down in this video, there is a break-even point where if you die before that point, you might end up paying more in taxes during your shorter than expected lifetime. Let's look at it here. The break-even point for this particular couple is, I believe that ends up being in their 80s, in their late 80s. That's not the case for everyone. For some, it's much earlier. For others, later still. I personally would rather have this smoother blue line, less surprises, even though there is a chance I could die up here. This yellow line is a little scary at a time in my life when I suspect I will prefer less surprises and scares. Now, this chart here is not accounting for the taxes that will be due by your heirs, so there is that to consider. Even though this shows that you might have paid less in your lifetime, they will still end up needing to pay some, effectively bumping this yellow line up. But unless you're unhealthy or for whatever reason not expecting that you or your spouse will live beyond this point, I personally would prefer the risk of paying that extra tax early on so I can avoid this increasingly large amount going to taxes later in life. Like I said earlier, I just love the idea of minimizing and eliminating, wherever possible, as many risks as possible. So why are more people not implementing thoughtfully calculated Roth conversion strategies like this each year? First of all, most people have no idea that this is an option, but even those who do often do not realize just how much of a difference it can make. And even when they are brought to that realization, it is more difficult still to come to terms with paying that much in taxes during those early retirement years. It can be painful to feel like you are losing that much to taxes. It's only when you study the long-term perspectives that you realize how much of a favor you are doing your future self, spouse, and heirs. Needless to say, trying to navigate all that on your own, although possible, is undeniably difficult. Now, you watching this video here on YouTube have probably seen other advisors on YouTube talking about this strategy. So it may feel to you as though it's pretty common, something with which most advisors can help you. But in practice, sadly, that's not actually the case. Often advisors at large household name firms have very little incentive to help you with this type of planning. I spent more than half a decade at the start of my career at one of those firms, sitting through countless workshops and trainings, and never once had the opportunity to learn the nuances of helping a client evaluate their Roth conversion options. I had to figure that out on my own. Anyway, I hope this has helped you see how much of an impact thoughtful tax planning like this can have on your financial future. If you have any additional questions, I look forward to chatting with you in the comments. I sincerely wish you all the best. Take care.